Starting the recorder. Welcome everybody. This is the Thursday evening Viper Trading webinar. If you're here to learn how to trade the futures markets using the Viper tools, you're absolutely in the right place. Let's go ahead and get our standard disclaimer out of the way so we can get on to some trades. All communications from Viper Trading Systems are for educational purposes only. Futures and Forex trading does involve risk, and there is a risk of loss. Nothing contained in this webinar or other webinars, including the live trading room, are to be construed as investment or trading advice. And of course, everybody in here tonight does know that you do trade at your own sole discretion. Okay, good. Now that we got that out of the way, before we get to a chart, I'm going to ask a question that I think will be helpful in driving, teaching, and tonight's topic, which is trade entries, seeing and knowing and taking good trade entries. So before we start, I want everybody to type in two things if you can, or one thing. The main thing being, what are the trade entries that you struggle with the most? In other words, if I was going to cover some trade entries here tonight, which ones, you can type in the ones you like too. Which ones do you like that you feel you're pretty good at? And what trade entries that you really just, no matter how you try to take them, you struggle with them, and they come and go, or you don't see them, or whatever issues you're having to try to fix those so we can address them here tonight. I'll give you a minute or two to type in. So we're looking for trade entries that you would like to see explained in detail that you're struggling with tonight. Oh, we got a couple of themes going here already. We got the Band-Aid. Everybody's saying the Band-Aid. Here's a good one from Craig saying, I can't seem to trade the chop. Very deep and very shallow. Hey, Doug, I didn't see you come in. He's saying very deep and very shallow. I'm assuming retraces on that, Doug, right? Kay giving some feedback that on crude oil, some of the pullbacks are very tough and deep and hard to trade. Yeah, Kay, that's unfortunately that's a characteristic of crude. I'll get a crude chart up here and we'll talk about how you can deal with that should you choose to continue to trade crude oil. Peter says taking trades against the trend before the trend changes. Yeah, that's a tough one. John's saying when I get into a trade and it goes against me. All right, yeah, that's a tough one. Here's a good one. This might relate to some other here. Jeff G is saying, I miss a lot of, smaller retracements, thinking that the tracement is going to go much deeper, and it never does. Joseph K. feedback real quick here. The opens of the markets tend to be very bad for me. I like when things slow down. Hey, Diane, good to see you. No problem. We're just getting started. Everybody's typing in their concerns in regards to trade entries. Peter is doubling up on the poor trading of chop. Getting in too late. That's a good one, Dave. Drago, how to handle phantom entries and managing stop levels. Are you suggesting that it might be easier to trade the YM? Well, I'll tell you what. Some days it is and some days it isn't. Most days it is, okay? YM tends to be a very somewhat smoother instrument. I really like it. Like Gary obviously likes it now. Everybody's 5-tick stops. I wish we could do 5-tick stops. Well, we'll look at some of those that might happen. Staying in a trade. Hesitating, getting in too late. Okay, good. I think we got some good theme going here. So let's get over to some charts before we get too long in the tooth in regards to time here. So let's come over to screen 1 and start to look at, I'm going to try to cycle through as many instruments as I can here tonight. So let's talk about some basics. We have some people still on free trial here. We have some new folks visiting us. So let's just set the basics, and then we can get on to looking at trade types. And then I'll start to, as best I can, get through everything that you typed in here. That was some great feedback. This is YM. This is the mini Dow. It's $5 a tick. I like to trade this. Gary likes to trade it. We have it a screen of this chart up in the room, and so we do trade calls on it. We trade it actively, and I know a lot of you in here tonight do trade it also. And so, I'm going to, for those of you that are just looking at this for the first time and trying to understand it, the first thing I say almost every webinar is that instrument selection is critical and key to your success. You could be the greatest trader in the planet in terms of a technical analysis standpoint, where you see different entries and all what have you, and if you pick the wrong instrument that isn't suited to your trading style, you can lose money, and it'll be kind of sort of counterproductive for what you're looking to accomplish. So, like I said, the ones that we have in the room are YM, the Russell, $10 a tick. We'll look at this chart tonight. We have NASDAQ, $5 a tick, a little choppier than YM. We have crude oil. Now, you got to keep in mind that in addition to these four instruments, there are other equities and other instruments you can trade other than the four in the room. I know a lot of traders that watch and trade the ES, the E-mini S&P. It's can be a little slow, and if you don't like chop, it's not really for you. It's $12.50 a tick too. EMD is $10 a tick. It moves a lot like the Russell, only a little smoother. Sometimes there's a liquidity issue, so you might get a little slippage in your fills. Some people like gold. I've heard a lot of comments of folks trading gold that do very well. It can be a little choppy and a little spiky, so you have to check it out. And the other two currencies you might want to check out, put a chart up and watch them, is the dollar index, DX. This is $5 a tick. And the Euro futures, 6E. Those are $12.50 a tick. You can look those during the European session, which is overnight my time, midnight to through the morning. That's DX dollar index and 6E Euro futures. Now on here, of course, we have the background colors, we have the bar colors, we have the bands, the mid band here, the thick chunky band in the middle, and 4 above, 4 below. Of course, we have the swings, we have the trailing stop dots, and the swing high lows. There's lots of other indicators we have. Most of you know we have the lightning, which Gary uses quite a bit for the swing levels, particularly in using trailing stops. The first one I would like to address, which seems to have some mystery and confusion associated with it, is what we refer to as the Band-Aid. So let me start with that. Just to orient everybody, I'm here in California, so all of this here is Pacific time. Midnight today was right here. So this is YM going into this morning's trading. Starting right here is midnight Pacific time, right here. Now, when we refer to Band-Aids, Band-Aids occur, let me explain what a Band-Aid is first, so we're all on the same page. And I'm going to take this area right at the equity market open, which occurs at 6:30 Pacific. And I'm going to really get very detailed about this because I know this whole notion of Band-Aid can be very confusing to some people, and that's perfectly okay. We'll talk about exactly what it is. So we'll clear up any confusion. And then what I'm trying to do here with what I'm going to show tonight is various entry techniques and various trade entry setups. And what I would like everybody to take away from this is to try to experiment with these different entries and then pick the ones that you like. You know what? I liken it to this. I'm sure we all have washer dryers, or we've all at some point used washer dryers. And so downstairs I have a washer dryer set up, and I don't know how many features are on each one of those. Probably, I don't know, 15 or 20 or more. If you have one of the modern washer dryers, there's lots of features on there, right? Different types of whatever cycles and different things you can do with it. Now think about, so that is what is available to you on those two appliances, right? Now think about how many of those you actually use, right? How many do you use? All 20 something features on all of your appliances? Probably not, right? So it's like that in trading. It's just like that in trading. when we build these tools and we show these charts and these instruments, we will show you different types of trade setups. And just like your appliances that have 20 different ways to do something, you might only want to pick 1 or 2 or 3 that work for you. And then you know what? Don't worry about the rest of them, because those trade setups might not be for you. But in all fairness to everybody that comes to us, we have to show them everything that's out there. Does that make sense? All right, let's start with the Band-Aid. The whole idea behind a Band-Aid is simply to flag an area at a specific given point in time. So for instance, in the room, we have 631, we call them banditos occasionally. It's a Band-Aid, and 632. And the reason we do that is because it's at the equity open of the markets. We're expecting good volatility, and we're looking for trades. Now, if we do I'm going to get really, really, very, very, very blown up and specific about this. So when we're done with this, there isn't any more confusion about what it is. So if you had a 631 bandito, I call it, of course, set in your indicators, that means that when 631 in the morning comes, wherever the price is located at that precise point in time, the software, the Viper indicator, will shade that band, hence the name Band-Aid. So at 631 on YM, the price was located right here. See it on that bar. So what will happen is at 631, the indicator will shade this band right here. And the typical duration for it is 30 minutes by default. So it'll just continue on out into the future. We have a second Band-Aid that paints on the equities and crude oil at 632. So what happens is at 632, which is right here, let me get the beginning of 632, right about there. Okay, now it's hard to say where exactly. It's looking like the price was still located inside of the 631 Band-Aid. If that was the case, then the 632 Band-Aid would paint exactly on top of the 31 Band-Aid. If, however, at 32 it was located on this candle here in this band just above this 631 Band-Aid, it would paint right here, like such, out into the future until whatever time you had it. Peter, you can't really adjust. You can adjust the time it comes on. You can adjust like the opacity and how long it stays on, but you can't. It forms, in some respect, a region in the fact that it's forming essentially inside or the band itself. And so let me explain the original thinking behind the Band-Aid, and then let me discuss how the trading of it has evolved. One of the particular challenges here is that the original Band-Aid was, and this drove sort of the impetus behind designing and building the object trader, was that at the specified time when the Band-Aid was being drawn, that you would simply take an object trader region box, engulf the Band-Aid itself with the region, activate longs and shorts as appropriate, and then when the market closed outside of that Band-Aid, you would be long or short. So for instance, in this case here, excuse me, hold on, I'm going to take a sip of tea. 1 second, please. Excuse me, sorry about that. So what we're saying is that per the original intent and design of the Band-Aid trade, that you would engulf this with your object trader region box, and when it closed outside of it, you would either be long or short. So in this case here on the 31 Band-Aid, had you done it as described, you would be filled long on this bar right here. Now, if you were filled long on that bar right there, you did feel what we call a little bit of heat as this bar pulled against you right here, back into the Band-Aid. Now, If you trade it out of the box with the settings that are on OT, so let's put some markers on here. You were filled long right here. And by default, the stop is 12 ticks below here. So let's go where you got filled at, let's call it 659 less 12 ticks is 47. So your stop would be, your initial stop would be down here if you traded object trader. Now, question. When a trade fires like this early in the morning and you get filled and it starts to move, do you have to leave your initial stop down there? No. You can move it. Furthermore, you can adjust the targets, you can adjust the stops, you can adjust the trailing stops, and I would suggest that you do to suit your instrument. A lot of people just want to take the object trader out of the box, just turn it on and figure it's going to start working and not adjust anything in it. Well, that's not how it was designed and built. That's just a starting point. What you need to do is take the instrument you're trading and adjust the stops and the targets. As mentioned earlier with crude oil and the Russell, sometimes you get deep retracements, you get pullbacks, you get things happening, and you need to accommodate for that with your instrument. But let's just play this one out. Now, notice what it does here. If this 32 Band-Aid painted here and you traded the 32 Band-Aid, what would happen? Well, if you enabled both sides, you would be filled long right here on that bar, right? Because that's where it came out, closed above the top of the 32 Band-Aid, right there, like such, if you had boxed it in with a region box using object trader. Notice here on the 32 Band-Aid, it pulled against you. You felt some heat on these bars right here. That's called drawdown, when you feel some heat when a market pulls against you. Interestingly enough, by the time you got to those bars there, the 31 Band-Aid trader is already up about 7 or 8 ticks. And so if you had a scalp target in anywhere between 5 and 10 ticks, it probably got hit right here. By the way, we suggest if you can, especially on these $5 instruments, as you're learning to trade, to try to put 2 contracts on if you can. And the thinking here is that you take a scalp trade between 5 and 10 ticks in length on the first leg of the move. You have 2 contracts with their initial stops here at 12 ticks. And then you want to eventually start to ratchet your stop up, either manually or using the trailing stops in AOT. And then you can set your targets, depending on your instrument, out further, like 10 or 15 or 20 ticks, which would be up here. Okay. Let's see how far this trade eventually went for the 31 Band-Aid trader. Say you got filled at 60, just some round numbers, and it got all the way up here to 80. So this move at the apex of the move to the top of the swing there turned out to be somewhere right around 20 ticks up here. So as an example, if you had 5 or 6 or 7 ticks as a scalp target on the 31 Bandito trader who got long at this point right here, you hit both targets. You hit the scalp and you hit a 20 tick pop. Okay. Let's say you had a 30 tick target and it didn't hit it. You could have dragged your stops up. Very aggressive stops would be following behind the close of the previous bar, and it would have taken you might possibly some out somewhere in here. So you gave up some at the end. Question from Craig. Let's say the price closes long outside the move of ticks and then it reverses. Do you take any entry reversed? Now that's a good question, Craig. Let me talk about that in how you handle the Band-Aid, because that can happen in choppy times. Or you could wait for the 32 Band-Aid. That's a personal preference. You can trade the 31 Band-Aid. I personally prefer the 31 Band-Aid because I know with some degree of certainty that the market is going to start moving at 631, and I want to be able to capitalize on it. Sometimes 32, by the time you get that extra minute in, the market's already moved. For instance, this one here, you would have already been up quite possibly by the time this trader's filled, and you've already got your scalp target done. Now, a word of caution. Several of you, when I asked that earlier question before we started showing the charts here, what is your main concern? And I saw several comments to the effect of, I always get chopped up at the open. Well, I don't know if you've heard me say in several previous webinars, if you get chopped up at market opens, then please do yourself a favor and don't trade them. You can wait 5 minutes, you can wait 10 minutes, you can wait a half an hour till 7 a.m. Pacific, 10 Eastern, and then start pulling the trigger. If you feel that you don't like the volatility at market opens, then by all means try to avoid it. Okay? There's nothing wrong. Everybody who trades these markets has different styles and techniques, different times that they like to trade. And then, and so I would suggest that you adjust your own personal style to those times. Now, another word about what happens here at these market opens that might be a little confusing if you're first looking at it is, to the left of this chart, you may have noticed that going into the open, you were in a pretty strong downtrend. All the equities had sold off before 6:30. Almost all of them look exactly like this in some form or another. In fact, pre-market here, in the pre-market session, there was actually two very nice short trades. One that came off of a mid-band consolidation right here. It was a nice short. And that retraced up into here. You got another rollover from the mid-band. You got a second short. This is all before the market's open. So some of you might be saying, and logically so, why wouldn't you have a downward bias on that box and only enable the shorts? Here's why. If you go back into the overnight session, the European session, when these markets sold off, you started up in here around the 760, 769 area, and by the time the market opened, it was all the way down here at 649. How much is that? That's 120 ticks. The market had sold off 120 ticks into the open. I don't know if you know about equity moves, but after markets have moved in one direction for 100 plus ticks, what tends to happen when markets move this far? I'm going to give you two reasons, by the way, why not to have a bias on that box. Almost any market, after it moves 100, 120 ticks in one direction, what does it do? Anybody? It can go sideways, right? Correction, retrace. Exactly. By the time you got down here, after this big sell-off, we don't know what direction it's going to go, right? So that's the first reason. Second reason is that at market opens and news events around 7 a.m. Pacific time, sometimes you get V-bottoms and you get double tops and you get things where markets reverse. And what happens is that if we're not prepared for that, then markets can run a whole bunch of ticks in the other direction and we wind up missing it because our bias was that move was just going to continue forever. Now, let's go back and blow this up again, and I want to talk about what happens after the 31-32 band-aids. Notice how, and this happens a lot. This happens a lot around those market opens and news events and high energy times. High energy times, for those of you who are new, are times in the market where we expect increased volatility and or a top or bottom to be put in. It's called high energy times. Those go, when you're a subscriber, they go out to you in emails twice in the evening, one for the overnight session and one for the morning session. Okay? All right. So notice what happens here. We come up, the 31, 32 band-aid traders have probably stopped out at some point here after this push up. Maybe you hit your targets, maybe you didn't. Nevertheless, there was some trades here. I think everybody sees that. By the way, before I move on, I'm going to go on to other trade types now. I want to make sure, before I do, everybody is crystal clear on what a band-aid is and the intention of how to trade it. Is there any other questions on what a band-aid is and how it trades before I go on from anybody here? I don't see any. Okay, good. I hope I was thorough and detailed about that. That's good. Notice what happens here. All right, so we're looking for a retracement to find some kind of support level, and you notice it pulls back into what was most likely the 32 bandito location. And it starts to get a slightly higher low here. Now, when I do visually, and you can do this on your charts, when I start to see this happen is you can actually put a little uptrend line right on your charts, and then you can use it as a ray if you want and extend it out into the future. Or you can do it visually. I've seen so many thousands of hours of charts that I can just sort of see it. But if you need something visual, put a line or a ray on it. Notice how you're getting a series of higher lows and higher highs. So what is that telling us? Possible trend change afoot, yes? We've already taken one long trade, but let's suppose you missed it. Suppose you missed this altogether. Now you're looking to get back in. What are we looking for to happen? I'm going to pause the screen and see if you can tell me what you want to do. Let me help you out. Okay, I'm going to unpause the screen. So now we're at 6:39. Market's open for about 8 or 9 or 10 minutes. What is happening right here? In this area right here. Right here, where my cursor is circling. What is this area right here? Just above the 32 band-aid. Between the top of the 32 band-aid and the mid-band, what is forming right here? This is another trade type that we like. In fact, most of you might know, this is actually my favorite trade type. I love this trade. I take this trade all day long and make money with it. This is my go-to trade. It's a region box forming at or around the mid-band. That's exactly what it is. It's consolidating right there. The tighter, the better. We have entire webinars dedicated to explaining how to see and take this trade. Nevertheless, the trade sets up where you have a very tight region of consolidation right here. Now, if you engulf this with a region box from Object Trader, you have to do a couple of things before you activate it. You have to activate the long side, the short side, or allow both. So let me ask you this. If you were trading YM this morning and it's about 6:39, and maybe you didn't get the band-aid trade, so now you're watching it and you want to start to take a trade, you see this region box forming, maybe you heard it called out in the room, you engulf it and you're looking for a trade here. Would you go long only, short only, or both? I'll give you 10 seconds. Long only, short only, or both on this region box YM 10 minutes into the market open. What would you do? 8 seconds left. You got to be able to quickly figure out what you're going to do in these things. Most of you know that, right? You can't dawdle around like, what am I going to do? I'm going to think about it a little bit. What should I do? No. You've got to get your subconscious trained so that, because, when the market's moving, it's not static like this. It's static right now, but it's shooting bars are going all over the place. You got to figure out what you're going to do quickly. Time's almost up. All right, time's up. Got some good answers. Most of you said both. Kay says preferring of the longs. Peter wants long only. A couple more. John wants long. Short from Doug. Okay. Captain Jack says both, considering the big move down, and a couple of more boths. Okay, good. Me personally, what I said earlier was that we are just a few 10 minutes into the market open here. We are expecting volatility, and furthermore, this is the important part, it can go either way. So what that means is that once you draw the region box like this, if you have longs enable, it will take a long above it. If you have shorts enable, it will take a short below it, like such. I would say, technically speaking, there's probably two good answers there. First one being both. I would do both. I think that's the correct way to approach it. If you said that you felt that the trend had changed to up and you want to do long only, that's perfectly fine. That would simply mean that if you got another leg down like this, you would miss it until you got a retrace. All right, so let's play this out and see what happens. Chop it in the box, chop it in the box, and we get a candle close up. So depending on how you drew the box, you would have been filled long, most likely on this candle right here. This candle right here. So you felt a little bit of heat as this one pulled against you. By the way, separate question. I wait for a close, Pervez. Yeah, I personally wait for a close of the bar. When the bar closes, that's where I get filled. Might get a little bit of slippage with it. How many of you feel nervous and when the market pulls against you and you're upside down, when you get filled? You know, you see that little ticker there, and you know you're filled at let's call it 71. Maybe you get a tick of slippage. Starts to pull back 668, 669, 667. You know, depending on how many contracts, you're starting to see that negative thing is going red. How many of you get nervous? Palms sweaty, tingling in the stomach, whatever reactions to the drawdown that we all have. Because we all go through it. If you trade money, you know what I'm talking about. And that's quite frankly the difference between trading sim money and real money, is how you react to the drawdowns. Let's face it, when you're in sim and you're drawing down, in your subconscious, you know it's sim, so you don't feel that actual fear and pain of the actual drawing down itself. However, when it's real money, you feel that for real, don't you? Yeah, of course you do, because it's real money, that's why. And by the way, that's one of the key critical things in transitioning between sim and real money. I don't want to get sidetracked here, but what you have to do is when you're sim trading, if you really want to get to the point of going live, you have to treat sim like it's real. In other words, when you're drawing down, that's how you're going to feel when your real money's in there, right? Oh, that's good. Thomas P. says, I even get nervous when I'm in sim and I draw down. Good. Jeff G. says, how bad I feel depends on how bad it pulls against me. Okay, good. Excellent. All right. So anyway, moving on. So we get filled. We're long. Market starts to move in our favor. We get a little pop depending on the target of your length of your scalper target. You know, if it's 5, 6, 8 ticks, 10 ticks, probably got taken out somewhere up in here. And you got a little runner foot here. Taking off. She's running back up. Running back up. Now I want to talk about trailing stops. Okay, now this is something that is, and it was several of you in the pre-webinar question had said something to this effect of stops and trailing stops and stops too tight are causing issues with your trading. Let me just go pan this out, and I'll talk about the different types of stops, trailing stops. We have the initial stop. In fact, I'm going to put the initial stop in here, and then I'm going to discuss different methods of trailing stops. All right, so you're filled long on this little region box at the mid-band here. We'll call it, what level was that there? That looks to be about 73. So a 12-tick initial stop would be at 61. So that's way down here. All right, so there's your initial stop, default by OT, unless you change it. Takes out this first target, so the 2 stops go down to 1 for your trail, if you put 2 on. Now, there are traders in these markets who put more than 1 contract on, or more than 2 contracts. Some can put 5 and 10, I've seen 20 or more contracts. When you're trading that much size and you're looking for runners to go far meaning 20, 30, 40 ticks, maybe 50, even longer moves, you're going to tend to have stops that are a little looser. Now, the stop techniques that you can employ are as such. If you are a trader who trades 1 or 2 contracts or smaller size, and you like the notion of getting in and out and banking your coin, then you're going to want to employ a tighter stop strategy. A tighter stop strategy would be to keep it very close, trailing very close to the swings of where the prior bars are, like such. A trader who employed that type of technique could be taken out on either this bar or this bar. See how tight that is? Now you pull back here. Let's say you got taken out on a reverse of that bar right there. You pull back and you get support, and then of course you see you get a little bounce, and you could have re-entered off of this area right here. The trader who comes in and out. This is a shallow retrace and does not get back to the midband. Another trader who is looking for longer runs, particularly at or near the open, is going to leave it looser. You see how you have this stealth line here? We don't talk much about the stealth line, but the stealth line can be employed as somewhat of a trailing stop if you don't mind leaving it a little looser. In which case you would leave it a little looser here, generally somewhere between the midband and here. Now you have to realize that when you use looser stops, let's continue this thinking on up here. When you have tighter stops, you're getting in and out, right? You're getting in, the market moves, you get out. You look for re-entry. You get back in, you keep a tight stop, you stop out, you're looking for re-entry. Comes down here, it bounces, you get in, tight stop, you're out. A trader with looser stops might keep it just a few ticks behind the stealth line and trail it up more like this and stay in that retracement. And so instead of having 2 or 3 trades on a move like this, it might be one continuous trade that eventually stops out somewhere over here, perhaps here or here. They both have their merits, and it's a personal trading style and technique of what you're going to have to develop for what you like to trade on your chosen instrument. If you're more of a scalper personality and you like to take the coin quickly and lock it down, you aren't really too concerned about the longer runs because you're just going to get in and out anyway, well then you would employ the tighter stop strategy. If on the other hand you are a trader that likes to leave it a little bit loose, especially in the morning when these runners start to kick in like this, then you're going to want to use a little bit of the looser stops, realizing that you're going to give back a chunk of it in the end when it retraces. So the apex of this swing here was 709, and you didn't get out on the looser stops until down here around this 97. So you gave up what? 10 ticks, maybe as much as 12 ticks on that last part, whereas a scalper trader who's tight was out much higher. Okay? Everybody see that? So it's a personal trading style, and that's frankly why in the room you'll hear me call different stop levels out, because it's a function of how tight or loose you like to keep it. Okay, good. So what we covered there was how to handle a region box. Just to recap what we've been over here so far, we had the 31. We explained band-aids. 31, both 31 and 32, how to approach them. How to take profits when they move up at the targets or swings, how to handle a mid-band region box 10 minutes into the open, and then how to manage your trailing stops, either tight or loose. Any questions? Those are two main trades, by the way. I mean, if you were to, sit me down and say, Charles, what do you like and what do you trade? I would say you're looking at probably the majority of it right here. This is what I like. I'm comfortable with it. It fits with my trading style and the instruments that I trade. Like I said, it's kind of my go-to setups. I like the band-aids because it flags an area in the bands at the times that I like to get in. And I love these region boxes. The tighter, the better. And not every day you're going to make money. I mean, some days you're going to get a little chopped up. On choppy days like today, let's pull another chart down and talk about chop for a minute. I didn't see any questions on what we showed so far. So let me come over to a Russell chart. Let me see if I can do a little contrast here between the two. Yeah, I'm going to do that. Let me see if I can do this. I'm going to try to do it this way. I think this is going to highlight this pretty nicely. See if I can get. I'm going to try to put the YM chart directly next to the Russell chart and show the exact same time frames with the exact same moves and how different they look. Okay, give me 1 second here. I will have it up in 1 second for you. There we go. All right, here we go. Let me try to get them lined up as best that I can. It's going to be a little bit off. They're going to look a little bit different. Ready? There we go. This isn't completely accurate. This is, let me get 630 over here. 630. No, hold on. That's not completely accurate. I'm going to show you how different this looks. Stand by. There. That's close. See how radically different these two look? Here is 3 o'clock in the morning Pacific on YM. You had this nice region box here, and then you had a beautiful little short trade set up. See it? And then you get a nice retracement up into the midband, and then you get a beautiful sell-off here. And then it starts to retrace at 630. This equivalent box here on the Russell at 3 o'clock, 2:30 to 3 o'clock Pacific is actually up here. Right here. See the difference? See the difference between the two? Chris, yeah, I use the out of the box 12 tick initial stops, but then I'm quick to draw them up once you get the scalper pop. I'm quick to draw them up. A couple of 5 ticks behind the entry, depending on what time and what instrument I'm trading. So that if it does flip, you can get out pretty quick. I think that's the one important thing I do want to say is that when you're taking these trades, you've got to be quick to move your stops. It's almost sort of a feel thing because sometimes if you're trading a spiky instrument and it tends to spike up and then spike right back down in your face, if you pull your stop up initially too tight too quickly, you can choke out a runner, and you don't want to do that. Anyway, back to the comparison here. So you had a little bit of divergence, quite a bit of divergence actually, because YM had actually peaked out way earlier in the morning and then had settled in here at the midband for a region box and then dropped off very nicely. Whereas by the time that was happening, that box right there, the Russell was still going up, right? It was still going up. So they were completely divergent. You get a nice drop here, you sell off, you come back, and here you get sort of a little spiky down. By the time you came into this area, you might have been a little confused on whether you were still going up or down. You might have used a region box with a preference to the upside and completely missed that short. But you did get another retracement back to the midband here, right around 5:30 Pacific when the news came out. I believe there was Philly Fed in the U.S. here at 5:30 Pacific, which is ironic because it was a bullish number, but the market sold off anyway, and I think the reason for that is that any kind of bullish news, it strikes fear that that's just going to push the Fed to raise rates in December. That's kind of the whole juxtaposition that's happening in the U.S. equity markets, right? It's all about the Fed keeping the rates at or close to zero, and so it's ironic because bullish news should theoretically move the markets up, where it doesn't because they're concerned about how the Fed's going to interpret it. Here's the site we use for those of you who are new, Forex Factory, for all our news on the financial markets. Here was today. I talked to quite a few traders over the past few days here who trade overnight. They trade Forex and they trade the currency futures. If you do, you should know about these high impact news events overnight, like if you're trading 6B or any of the British pound cross pairs. Keep an eye on these news that affect the euro and the British pound and whatever you're trading. Yeah, Carl. We got a couple of big bullish days on the markets here in the U.S. too. So here's our Philly Fed. See, it's a bullish number, a decent unemployment claim number too. So theoretically, markets should be going up, but they sold off because of those concerns on the rate. Now let's follow on with our thinking here. So we roll over. We get the short trade around 5:30 on both. All the equities roll at various levels, and you get this sell-off right here. Now, when I say the term spikiness, what I'm referring to is the nature in which they move. Notice how when you have this move down on YM, it's kind of methodical. It comes down, retraces a little bit, kind of stays under the stealth line, fairly clean and methodical. Notice what happens on the Russell. On some of these retracements, and some of you said this earlier in the pre-webinar comments, that sometimes you get these spikes on the Russell, and crude and gold is notorious for this too. So you could be in short here. You're trailing your stop, and life is good. Whoa, boop, boop, takes you right out if you're too tight. Let's continue on down to 630. Here is 638 on the Russell, 640. In the meantime, what was YM doing at 640? Here's 641. Here's 641 on YM right here. Do these look even closely alike? I'm talking about this area right here. From the bottom of the sell-off through the open into the first 10 minutes of the market. This is what you're trading on YM. You've actually, by that point, taken 2 long trades and are trailing stops or have already hit targets. The Russell is still selling off. It's like nobody got the up party news over here. Diane asking if you, and there's nothing wrong with that. By the way, some people misunderstand my comments that if I say something negative about an instrument that I'm disparaging it in some way. No, I'm not disparaging it. All I'm trying to say is that I'm highlighting the fact that the volatility really varies from instrument to instrument. And if you find that the instrument you're trading is too spiky for you and you're getting taken out of stops, it's not quite hitting your targets and it's retracing in your face, well, then maybe that volatility is not for you. And to go find an instrument that is. Diane's saying here real quick, when you choose both long and short on the box, and it closes outside, one direction only, moves about 5-6 ticks, coming back into the box and closes outside, how do you handle this? Well, Diane, that's a function of a couple of things. How many contracts you have on, and where your stops are located, right? So if you let's do a hypothetical on one of these boxes. So let me see the best way to answer this question. On the surface, it seems like a pretty simple question, but let me answer it in this way, and let me do it on the Russell chart because we've already looked at this YM to death here. And let's try to do this in this way. I'm trying to look for a little box that we can show a good illustration on how this could work. All right, let's do a Russell box. And I'm going to blow this up at 640. And let's suppose you drew a little object trader region box, right, like such in this area right here. Okay. This little consolidation region around the mid-band where it kind of sat here for a couple of minutes. You boxed it in, and so let's say you left both sides open, or you believed it was a trend change and you traded the long side. Either way, if you had both activated, or however you configured this, you were filled long on that bar right there. Now, if you had 2 contracts on with a scalper and a runner, then depending on the length of your scalper, it probably was taken out somewhere up here, because that looks to be about 8 ticks or so. And here's how I'm answering your question. So the 12 ticks, let's say we're filled at 68.50, less 12 is 60. So your initial stop is down here. And you configure it so that after the first target's taken out, you raise your stop up 7 ticks to 5 ticks behind your entry. So now you're sitting, say, up in here somewhere. Now, if it's two contracts and you hit the initial scalper target, the 2 initial stops that were sitting down here now go to 1 because it's OCO. I know, Diane, I'm going to answer your question in this way. Let me explain it because it's different. It's different if you have 1 or 2 contracts. That's what I'm trying to explain. If you have 2 contracts, this all becomes one continuous trade. If the bars come back into this box and never stop out, say theoretically it came all the way back into the box and chopped around in here and then broke back up and never got your stops, well, then you have one continuous trade. It never gets in and it never gets out. It never gets out of it. It's just one continuous trade, and it'll leave that stop and it'll leave the target in here wherever it is, and it'll just let that trade run. If, on the other hand, you had 1 contract and it hit the target here on your scalper, and in our theoretical case, hold on a second. Okay, so it hits the scalper, and you only have 1 on, right? So now this stop is gone because it took out your scalper, and then it retraces in the box like this, choppy chop chop, chopperoo, and then it breaks up. Now you get back into another trade. And that would be true at the bottom too, Diane. So it's a function of a couple of things: how many contracts you have on and whether or not it hits the targets and stops. If the market comes back into a box, whether it's a Band-Aid or region or however you drew it, and you enable both sides, if you are taken out of the first leg of the move and it comes back in and then comes back out, you will be filled with a second trade. Does that make sense? If you have multiples on and it hits the target and never gets the stop, then the first trade continues on until it's finally hits its target or its stop is taken out. And once again, that would be true at the bottom or the top. So if it was short, same thing. Here, let's do this one over here. Let's say you had this short over here and you're filled short, and it comes down, hits this, and then all of a sudden it retraces back up into here. If you had 1 contract on and it comes back up into the box, so there's no remaining targets or stops, you're flat, and it comes back in the box and then breaks down again, you get a second short. I don't know. You got one. I'm not sure exactly what that question is. If the box took you one way first, then reverses. Well, the only way that can happen is if you activate both sides long and short. If you have both sides activated long and short, it will fill you long and then it will fill you short. It can fill you long on a break up, and if it breaks down through here, it will fill you short. Either direction is what you're telling it to take. If, on the other hand, it breaks down like this, you get a short, and then it comes back in a box like this, and then you don't activate the long side and it breaks up, it would never take the long. So it's only going to take the sides that you have activated, whichever direction it's going to break. Okay? All right, we're almost out of time. I got just a couple of minutes left here. Appreciate everybody sticking around for this. I want to show a couple other trades real quick, and I want to show you something that you might want to consider. I'm going to drag down a crude oil chart real quick here, and I have a couple of topics I want to discuss before we wrap so that we round out our discussion on trade setups and entries. Before I do that, let me take another quick sip of tea. The charts are locking up here a little bit. They're not being too friendly. Excuse me. Hold on one second, please. Chris, I see your question there. I'm going to have to hold on that for a minute. I'll circle back to it. Since I'm almost pretty much out of time here, I wanted to get a couple other comments in real quick to address some concerns about some folks that were voicing concerns here, not only in the room but earlier. What do we think about a market that looks like this? In particular, I'm referring to this area right here. This is crude oil yesterday. Walter says, yikes. How about this area? You like this area right here? How about that? You like that? So here's the thing. Let me just say this as quickly as I can. I'm going to put this as succinctly as I can, so there's absolutely no confusion about it. Okay. Sometimes markets are just choppy. Okay. They go sideways. Sometimes they respect the swing levels and bounce in a nice little range that you can scalp. And sometimes they don't. Sometimes they, now this happens to be right around the crude, right before the crude oil inventory. So I'm just picking this out. I know it's choppy because of the inventory number coming out, but notwithstanding whether the inventory number was coming out, we would all agree that this is pretty darn choppy. Okay. There is nothing wrong with standing down and not trading for some period of time. There are times when it's completely appropriate to not take trades. Sometimes I feel like when we're in the room that we should always be talking about trades, and every second of every minute that we should fill the air with trade calls. The fact of the matter is there's a lot of times where you just shouldn't be trading. If the market's choppy and nobody's saying anything in the room, then either there's no trade setups or it's going sideways, and we're more or less saying you should probably just stay out of this. The way that you would know this, one of the main ways that you can figure this out as it's starting to happen is that you start to watch what the market's doing, like such. Well, all due respect, going into this is pretty choppy. So this is the 18th. This would have been midnight yesterday right here. Look at this chart. I mean, okay, let's take a different approach. If you see a trade on here, somebody can see a trade on here, you let me know what it is. I'll give you a minute. Do you see a trade on here you would take? Now pretend this is real time. You're seeing it just statically after the fact. Pretend this is happening in real time and this is what you're seeing. Where do you see the trades? Where would be a trade on here? I don't see anything. At defined support and resistance levels. 438, 433 in the morning, perhaps. Well, I mean, possibly. I mean, I suppose it would be how quickly that it was moving. I'm simply trying to illustrate that sometimes markets are very choppy. They're not trending very nicely. They're hard to see. If you believe that the trend was down through this period of time, for instance, over here, you were making the case that you sort of had somewhat of a downtrended channel here. Each time it came up and rolled, yeah, you could be shorting it. Okay, here you didn't get up very high. Here you didn't get up very high. You might get a little fake out there. Here you got totally whipped around. Yeah, I mean, sometimes markets are just choppy, and you have to decide: is this something where I'm going to try to get in here, step up, and pick off some trades? I see where I want to get in, or you go pull up another chart, pull up something else, pull up the Russell, pull up NASDAQ, pull up gold, put the dollar up, find something else. People are still typing in trades. All right, now eventually what happens, let's show that, markets don't stay like this forever, okay? And this is the second thing I wanted to show before we wrap. After the news yesterday came out, the markets were still a little choppy, but they did start to break down. And here's what you could have noticed. It looks to be about 25, 30, 45 minutes after the news came out, is that So here's the shotgunning of the news right here. You're more or less in a range, and then it breaks the bottom of the range, and it starts to trend down a little bit. You start to get a red background. Here you're in transition, and you're putting in a series of lower highs, arguably like such. Now notice what happens over here. Now you're starting to get some more trending-like action. So what happens is markets consolidate, they go sideways, they go range-bound for some period of time, and then usually they'll break out and start to move one direction or another, either up or down. And then they consolidate again, then repeat, repeat, repeat. Notice over here what's starting to happen was after you thrush down through this swing right here, like this, you come back up, and now you're starting to check the mid-band, and it's starting to roll. You had a couple of chances to take shorts right here. See the rolls at the mid-band? You can make the case that these are retracements in what is now a downtrend. So that's one of the final types of trades that I wanted to show. I think everybody in here, almost everybody, should know that trade. You got the Band-Aid trade, you got the mid-band region box, you got the high energy in the news boxes, and then the other sort of go-to trade is retracements in a trend. And simply all we're doing there is if you're in a downtrend, we're looking for retracements up into swing levels at or near the mid-band, a little lower or a little higher. We're shorting those. And then here you can see the market breaks down and we start to get some follow through to the downside. See those trade setups? Then you got a nice sell-off right after that if you were still trading oil down here. I'm going to go ahead and stop the recorder. Final questions before we wrap. Thank you for sticking around, everybody. I appreciate your time so much. Hopefully you picked up a couple of nuggets out of this tonight you can use in your trading tomorrow or tonight whenever you trade, whatever instruments you like. Get in there and trade them. Okay, Murray. Yeah, this was recorded. Oh, I forgot to stop the recorder. Hold on. Stand by. By the way, did everybody see this last trade setup I was talking about here? Let me make sure everybody saw this right here on crude. Shotgunning, starting to drop, lower highs, lower lows. We get the red background. Now we're looking for retraces, get the short set up, and then we finally had a nice drop off.